If you have credit, you'll get wiped out. It's as simple as that. So you're going to continue to be very wary about the situation following what is now looking like going to be a great inflation yet again, a collapse of the currencies, fiat currencies.
We knew back then that there was manipulation. We couldn't prove it, but we knew it. You could see it. You could see anything that would be gold bullish or silver bullish. They would smash gold, they would smash silver. And then, of course, they'd point at the price and say, see, gold bad, dollar good.
Gold and silver prices aren't just moving randomly. They're being held down on purpose. Price suppression in these markets is one of the most powerful, yet least talked about forms of financial manipulation in the world today. For decades, the system has quietly worked to keep gold and silver from exposing the cracks in the global credit market. If these metals were allowed to rise naturally, they'd signal that fiat currencies are crumbling. And that's the last thing central banks want you to see. That's why those same central banks and sovereign wealth funds have been hoarding gold behind the scenes, preparing for the day when paper money can't buy trust anymore. Here's the truth. Paper contracts and ETFs are just promises. Real physical gold and silver? They can't default. They don't rely on anyone's balance sheet. They are your last line of defense when the financial system shakes. Bill Holter has spent decades watching how this game is played. As a broker and branch manager, he saw firsthand how the market was rigged to keep the illusion of stability alive. Paper instruments might look convenient, but they leave you totally exposed when the system breaks. Only real bullion or properly documented certificates give you true ownership. And silver? That's the ticking time bomb. Its supply is tiny compared to demand, and demand is exploding across tech, solar, medicine, and even the military. There's no giant silver stockpile waiting in the wings. Any delivery failure could spark a chain reaction that sets off the entire market. Holter's warning is urgent. If you're only holding paper silver, you could lose everything when the stress hits. The clock is ticking. The difference between credit and real money has never mattered more, and securing physical assets may be the only way to protect your wealth before the storm hits. Now, let's go straight to Bill Holter's interview. And before we dive in, smash that subscribe button and hit the bell so you don't miss what's coming next.
Gold is being purchased primarily by sovereign wealth funds, central banks. They understand that the dollar is going to get smoked, and whatever dollar balances they have, those are going to be black holes on their balance sheet. So what they're doing is they're stocking up on gold as a way to try to replenish their balance sheet when things collapse. Because gold and silver cannot default. They cannot be diluted permanently. They can be diluted temporarily, which is what COMEX does and LBMA does by selling naked contracts. But what that'll lead to, and I've said this all along, it will lead to failure to deliver. My opinion is silver will fail to deliver first. But once you get a failure to deliver in either market, the other one blows up and all markets will blow up, because that will be the cracking event. You saw that in 2008. I mean, all the trillions that were spewed all over the world. You saw that, or you've seen that going back 10, 15, 20 years. There was speculation that longs that would stand for delivery all of a sudden vanished. And the belief was they were getting paid 20, 25% fiat premiums, should just walk away. What would happen is, and let's just use a number of 10,000 contracts, would be standing for delivery on first notice date. And by final notice date, it might be down to 3,000 or 4,000 contracts. Now you start with 10,000 contracts, and by the end of the month, it's 15, 20, 30,000. So what's happening is you've got buyers that are coming in during the month and then standing for delivery. And what that does is that's going to take an awful lot, or it's taking an awful lot more physical out of the inventories and bringing that failure to delivery moment, much more forward.
Yeah, the day is coming, without a question. The day is coming.
It's going to happen.
Yeah,
it will happen.
So we just talked about silver. Why do you think that one's going to be the one to fail on delivery first?
Oh, because it's the smallest market by far.
Okay.
I mean, the whole market, global production is what, 25 billion a year, maybe $30 billion a year at these current prices. $30 billion today is nothing. I mean, you've got individuals that could write checks for $30 billion, and that's total global production for a year. It's in a structural deficit, 450 to 500 million ounce deficit over the last 4 to 5 years. The inventories on COMEX have, and especially LBMA, have lessened. It's just the easiest market to break because it's the smallest. And it also has the most, if you compare it to gold, gold has monetary demand. That's it. Mm-hmm. Silver has monetary demand. It has demand. Well, gold has jewelry demand too. But silver's got medicinal demand, industrial demand, technological demand.
All sorts of new demands.
And every time we fire, these high-tech missiles, we're firing a monster box of silver. The amount of silver that's used in the military is unbelievable.
I didn't even
so there's just so many different silver, and it's such a small market. There's no backup. There's no big pool of silver sitting anywhere, whereas central banks all over the world, do hold large balances of gold. Let me just point this out. I was a broker up until 2006. I left the country late, the very end of the year, thinking 2007 and 8 were going to happen. They happened. I was out. But as a broker, and I did this as a branch manager, and for a branch manager to be getting calls from compliance once a week or once every 2 weeks, because I built one of the largest gold, silver, and mining share positions in the country. We knew back then that there was manipulation. We couldn't prove it, but we knew it. You could see it. You could see anything that would be gold bullish or silver bullish. They would smash gold. They would smash silver. And then, of course, they'd point at the price and say, see, gold bad, dollar good. And that's so for you to say, all I'm trying to say is I've been through this way many, many, many more years than you have. People giving me crap because I had this crazy view that, oh my gosh, turned out to be right.
Alasdair Macleod has been sounding the alarm for years, and now his warnings are coming true. He's been saying that our entire system is built on fragile credit, and when the cracks start to show, it unravels fast. Investors borrow on margin, markets turn against them, and suddenly they're forced to sell into a market with no buyers. That's when the Federal Reserve and the Treasury swoop in as buyers of last resort. Sure, it props the system up for a while, but the cost is devastating. Every rescue destroys the value of the dollar. Macleod says we're heading straight toward a scenario that looks a lot like Germany in the 1920s, where hyperinflation made cash worthless overnight and gold became the only thing that mattered. This is the wake-up call. If you're sitting in cash or living off credit, you're a target. The people who hold real assets, gold, silver, farmland, hard property, will be the ones who survive financially and keep their buying power intact. And this isn't just a money story. This is about survival. In a currency collapse, food supply chains break, shelves go empty, and people in cities are hit first. History proves it. When money dies, societies destabilize, riots break out, and political extremes take over. Macleod's message couldn't be clearer. The clock is ticking and the window to prepare is closing fast. Now, let's jump into the clips from his interview and pay close attention, because what he says next could be the most important warning you'll hear this year.
If you don't hold gold, and I suppose also silver, there are other things, in this sort of catastrophe, actually having the means of producing your own food actually does become rather important. Living in cities puts you at a great disadvantage. Because the distribution of the basics which we need, particularly food, that's going to break down. Who with, sort of producing, whether it's vegetables or meat or whatever, is going to want to sell stuff into cities for people who can't afford to buy it? Well, sorry, cattle, you're going to live a bit longer, sort of thing. That is a real trouble. If you have credit, you'll get wiped out. It's as simple as that. Think what 4 trillion marks were, if you like. I think, it was some figure like, I can't remember, but I think before the war, the total money in circulation was measured in sort of, I think it was measured in billions of marks, of Reichsmarks, not trillions, even possibly millions. But it was a very, very low figure. So if you've got unbacked fiat dollars, they're not going to buy you a cup of tea at the end of the day. On the other hand, if you've got gold, you can cash that in for worthless dollars, which you'll spend extremely quickly before they become even more worthless. That was the lesson, really, of that experience. And not only that, but if you do have gold, and particularly if you've got legal tender, it varies, the laws vary from country to country, but if you've got legal tender, then you can presumably use your gold to buy real estate, for example. or by farmland, or, nice country estates, or a hideaway away from anywhere, which might insulate you from trouble. But I mean, this is a very, very serious issue. It's going to be very damaging for virtually everybody, because let's face it, very few people actually have gold, or have gold in any sort of meaningful way. I mean, we haven't even touched on problems that follow. I mean, if we pursue the analogy with Germany, of course, the complete collapse of the currency and the economy in 1923 led to political instability. It led actually to Nazism, Hitler, and all the rest of it, and World War II. So the idea that this is just going to get the whole thing out of get it out of the system, and then we can get on with lives, and it's not that simple. It really is not. So you're going to continue to be very wary about the situation following what is now looking like going to be a great inflation yet again, a collapse of the currencies, fiat currencies. And the thing that is actually very worrying is I can't see how any politician in the West has the mandate to actually address the problem. And it's in that context we should be more sympathetic about the problems that the German political class felt or faced back in the early 1920s. I'm sure, and if you read into it, you will find that there were people who knew what they were doing. They knew that what they were doing was wrong, but they basically had no alternative. That was the way of it. The term stagflationary actually amuses me slightly, not just because it was my uncle who came up with it in a debate in the House of Commons back in, I think it was in the late 1960s. It wasn't quite in this context, but it's being picked up. I mean, the fact of the matter is, and this is something which Keynesians don't understand, macroeconomics, economists don't understand, is that production is linked to consumption. Basically, when you get a recession and people get sacked, then their productive ability within the economy declines. So, because guess what? Things are bad. You cut production as well as, consumers cut consumption. So the thing sort of goes along. The most important thing actually is not, whether that's true or not, but really, if you get a decline in the value of the currency, which of course, with currencies being entirely fiat, is not that unusual, then the purchasing power of the currency is going down. So inevitably, the costs of things measured in a declining currency go up. And so this is the explanation for stagflation. And I mean, the economists who denied Say's law, which was their sort of, if you like, the sort of fundamental tenet of classical economics, just completely ride roughshed over the experience, if you like, of previous inflations. I mean, when you get a massive inflation, what we call a hyperinflation, then, is this accompanied with a booming economy? No, it's accompanied always with a collapsing economy, yet prices rise. So how do you get the situation where you get a collapsing economy and inflation and you get surprised by it? I mean, it's inevitable that the two things actually go together. So the Keynesians, by trying to dismiss Say's law, have got this one completely wrong. So to me, what we call stagflation is actually quite a normal phenomenon. So, and that's basically where we are. I mean, if you look at the recent unemployment numbers, also go around the States, just as the same as I go around Britain and, talk to people not in the major financial centers who are on a different planet, but go and talk around Main Street, smaller companies, small and medium-sized companies, ask how they're doing. And you'll get a completely different answer from this sort of hype that, the economy is going well, et cetera, et cetera. It's not. Things are actually not that good out there. Prices are higher or rising faster than the statistics suggest. That's a very important point. We're also seeing food prices, more importantly, rising really quite quickly. And unemployment, I mean, the jobs just aren't there. I mean, I don't care what the BLS says. I don't care whether Trump is right about, they're getting it all wrong and all the rest of it. The fact of the matter is that government statistics are self-serving and they are not accurate. Just go around and see what's going on in the economy and you'll get a far better idea. And I'm not in America, but I can tell you here, and I guess the same is there, that the economy is actually in decline. And we can also show this mathematically in a way in which economists fail to do. Just take the budget deficit, which in America is around about, 6.5–7% of GDP? Take that out of GDP, and what do you get? You get a contracting private sector GDP. There's your evidence. In other words, GDP is falsely being ramped by the government deficit. Government deficit 7%, GDP growing nominally about 4.25% or something like that, means that you're actually contracting by somewhere between 2 and 3%. It's been doing this for a couple of years. Need one say more? The evidence is.
Looking forward, the writing on the wall is clear. We're heading into a period of major volatility and structural change across the financial system. As trust in credit and fiat currencies continues to crumble, the gap between paper assets and real, tangible wealth will grow wider than ever. With tight supply and skyrocketing demand for physical gold and silver, disruptions could hit faster and harder than most people are prepared for. Those who stay in paper promises risk taking the full hit, while those who hold real assets will be in a position to survive and maybe even thrive when the dust settles. This is the time to plan carefully, stay alert, and truly understand how systemic risks can snowball into a full-blown reset of the financial system. Q&A for you. Do you think we'll see a failure to deliver in silver before the end of the year? Are you already stacking physical gold and silver, or are you still trusting paper assets? How would you protect your family if supply chains break down? Drop your answers in the comments. We read every single one, and your perspective matters. And if this video opened your eyes, smash the like button, subscribe, and turn on notifications so you don't miss what's coming next. Big changes are here, and the next video could be the one that prepares you for them.